Good day. This is a walkthrough of a financial feasibility analysis conducted on three investment options over a 5-year period. The first option considered is to rent out the unfurnished apartment on a year-to-year basis using the services of a rental agent. To start this analysis, an estimated rent increase rate is determined using past figures. The total increase over 56 months is found to be 19.11%. This value is then used to calculate the weighted yearly increase rate, and using this rate, the estimated rent income can be determined for the 5-year period. Note that the floor tiles was chosen not to be installed and the income due to the installation is omitted. The reason for this decision is illustrated in the next table. To determine whether to install the tiles, we first need to consider what type of financing to use. With some research, it was found that overdraft facilities offered through credit cards charge interest rates of between 15 and 20%. Personal loan interest rates can be between 15 and 25%. For this reason, it was decided to rather refinance the mortgage to pay for the expenses, as the interest rate offered is 10.75%. This option is used throughout this analysis for any expenses incurred. But getting back to the floor tiles, the yearly rent income due to the 800 Rand monthly increase is shown here. The average yearly increase rate of 4.09% is applied to this income to get the subsequent income values. To calculate the yearly mortgage payment, the following parameters are used, and it comes to an amount of around 4,500 Rand per year. Using these values, the yearly profits can be calculated to determine the net present value at an inflation rate of 4.9%. The total net present value is calculated to be around 25,000 Rand, indicating that replacing the tiles is not a worthwhile investment when comparing it to the initial cost of 35,000 Rand. Next, we use the same procedure used to calculate the rent increase and apply it to the historic data of the levies and taxes. This enables us to calculate the yearly amounts for each of these expenditures. We now have to calculate the new payment to cover the expenses for plumbing, maintenance, and the installation of a new stove. This brings the total refinancing amount to 422,000 Rand. And using these parameters, a monthly payment amount of 4,500 Rand is calculated. Next, we need to calculate the tax relating to the rental income. To do this, all personal income is calculated and added to the rental income. The routine fees tax deduction is determined by using an estimate of 1% of the initial purchase price per year, and the agent fees deduction is taken as 15% of the rental income. Using these volumes, it is possible to calculate the yearly taxable amount and the subsequent tax resulting from the rental income. Using all of these calculated values, we can construct the cash flow table. The net present value is calculated using an inflation rate of 4.9% and is found to be a negative value, thus making the investment in its current state not a good option for the client to choose. However, we can create another alternative by implying that the house will be sold at the end of a 5-year period. To evaluate this alternative, some more calculations are required. First, we need to estimate the property worth at the end of the 5-year period. This is done by applying the average growth rate per year to the current data, bringing the estimated property value at the end of 5 years to around 1.2 million Rand. Next, we need to calculate the tax relating to the capital gains, and this is found to be equal to around 72,000 Rand. The amount owed on the refinancing mortgage is found to be 335,000 Rand after 5 years. Selling the house requires an estate agent, and the rate of 1.9% of the selling price is based on a sole mandate agreement, resulting in an estimated cost of around 27,000 Rand. Adding all of these new factors to the cash flow table, we can see that a positive net present value is the result, making this an attractive alternative for investment. The next option to consider is to rent out the furnished apartment on a short-term basis through the Airbnb platform. Many of the calculated expenses are identical to that in option 1, like the levies and property taxes. The first value worth noting is the payment due to refinancing the mortgage. This includes furnishing the apartment and all of the other necessary expenses, like plumbing, maintenance, and replacing the stove. With some research, it was found that the expected income from using the Airbnb service could be a total of around 86,000 Rand per year. Using the aforementioned values, we can calculate a net present value for this scenario, and it is found to be also a negative value. Again, we also test the alternative of selling the property at the end of the 5 years. The only value we need to recalculate is the amount owed on the new mortgage, which totals 413,000 Rand. Using all these calculated values and adding a 3% service fee for the Airbnb service, the net present value is calculated to be a positive value of 278,000 Rand, making this a viable investment option. The final option to consider is to sell the property through an estate agent and invest in a portfolio of maximum 3 unit trusts. First, we need to calculate the capital gains tax when selling the house. This is found to be around 26,300 Rand. Next, we calculate the estate agent fees when selling the house, and is found to be around 20,000 Rand. After deducting the mortgage repayment and the necessary plumbing that needs to be done on the house, the investable amount is found to be around 460,000 Rand. 3 unit trusts were chosen as they gave the highest interest earned over on the last 5-year period. We will split these the funds available for investment equally into these 3 funds. The taxable worth at the end of the 5-year period is found to be around 192,000 Rand. The tax payment required after cashing in your shares is around 67,000 Rand. To summarize this whole scenario, the net present value is calculated to be around 680,000 Rand. To provide a summary of all the options shown here, this table was created. It clearly illustrates that investing in unit trust would be by far the best option when considering the net present value. Thank you very much.